Right now, as you watch this video, three companies are sitting in the boardrooms of nearly every major corporation on Earth: Apple, Microsoft, Amazon, Google, JP Morgan Chase, ExxonMobil, Pfizer. Three names appear at the top of the shareholder list for almost all of them: BlackRock, Vanguard, State Street. Together, these three asset management firms have become the largest shareholders in 88% of the companies that make up the S&P 500. They collectively control over 20% of the total market capitalization of the United States, and they own approximately 25% of all voting shares in corporate America. That means when decisions are made at shareholder meetings, who runs a company, how executives are paid, whether a merger happens, these three firms cast the deciding votes on behalf of over 150 million ordinary investors. Most of those 150 million people have no idea this is happening. This is the business architect. And today we're going inside the most consequential power structure in modern capitalism. One that was built not in secret, but in plain sight. To understand how three companies came to sit at the top of global finance, you have to go back to a financial idea that seemed completely harmless, even boring. Index funds. The concept is straightforward. Instead of paying an expert to pick winning stocks, you simply buy a small piece of every company in a market index, like the S&P 500, and hold it forever. For decades, this was a niche idea for cautious savers. Then came 2008. When the 2008 financial crisis wiped out trillions in actively managed funds, millions of investors lost faith in the stock-picking industry. They moved their money, en masse, into passive index funds. The result was an unprecedented migration of wealth, and the three firms that offered the biggest, cheapest, most trusted index funds, BlackRock, Vanguard, and State Street, absorbed virtually all of it. As of Q1 2024, BlackRock managed $10.5 trillion in assets. Vanguard managed $9.3 trillion. State Street managed $4.3 trillion. That is a combined $24 trillion, a number roughly equal to the entire annual GDP of the United States. And together, as of February 2024, their funds account for 74.3% of the entire equity ETF market in America. This wasn't a conspiracy. There was no secret meeting where three men decided to take over the world. It was the logical endpoint of scale. Index funds are a business where the bigger you are, the cheaper you can offer your product, and the cheaper you are, the more customers you attract. Each wave of new investors made these three firms bigger. Each increase in size made their fees lower, which attracted even more investors. A perfect, self-reinforcing loop. And now there is no realistic competitor on the horizon. The index fund industry is a winner-take-most market, and these three have already won. Here is the part that almost nobody talks about, and it is the part that matters most. Every public company holds annual shareholder meetings. At these meetings, the people who own shares vote on critical decisions: who sits on the board of directors, how much the CEO gets paid, whether the company should merge or spin off a division. When you invest in a BlackRock, Vanguard, or State Street index fund, you are technically a shareholder in every company that fund holds. But in most cases, you do not vote. They vote for you. In the 2024 to 2025 proxy season, BlackRock supported 98.72% of director re-election proposals at S&P 500 companies. Vanguard supported 99.3%. Let that sink in. The largest investor in corporate America agrees with management nearly 100% of the time. This is not just a statistic. Research from multiple sources shows that corporate CEOs are acutely aware that the big three are their dominant shareholders, and they factor that into every major decision they make. A 2017 landmark paper published in the peer-reviewed journal Business and Politics, authored by researchers at the University of Amsterdam, documented exactly how this works. The paper, titled Hidden Power of the Big Three, showed that these firms had become what the authors called the de facto permanent governing board for a substantial portion of U.S. corporate America. Bloomberg described BlackRock as effectively the fourth branch of government. That wasn't hyperbole. It was a structural observation. And the connection to actual government goes far deeper than a metaphor, which we'll get to in a moment. Let's talk about which specific industries are most impacted by this concentration of ownership, because this is where the hidden costs become very real for ordinary people. Aviation. The big three are the largest shareholders in American Airlines, Delta, and United Continental simultaneously. A peer-reviewed study by economists at the University of Michigan found that this common ownership arrangement, where the same investors own all the competing airlines, has contributed to airline ticket prices being 3 to 11% higher than they would be if the airlines had different owners. The logic is simple and brutal. If you own all the airlines, you don't want them to destroy each other's margins by competing aggressively on price. You want the whole industry to be quietly profitable. Banking. The big three are simultaneously the top shareholders in JP Morgan Chase, Wells Fargo, Bank of America, and Citigroup. A separate academic study on U.S. banking competition found that this common ownership arrangement is strongly correlated with higher fees charged to bank customers. Pharmaceuticals. The big three hold major positions across competing pharmaceutical companies. Critics argue this creates the same incentive structure: less competition, less pressure to lower drug prices, more stable profits flowing upward to the concentrated owners. Defense. They hold significant stakes in Lockheed Martin, Raytheon, Boeing, and other defense contractors, all simultaneously. Energy. ExxonMobil, Chevron, and major renewable energy firms all share the same top shareholders. The big three sit on both sides of the energy transition debate, in both fossil fuels and clean energy simultaneously. Technology. Apple, Microsoft, Alphabet, Amazon, Meta. The 5 most valuable companies in the world. The big three are among the top shareholders of all 5. What you are looking at is an ownership structure where the same 3 entities sit at the apex of nearly every strategic industry simultaneously, with no obligation to want any single company to outcompete the others. But the power of the big three, especially BlackRock, goes far beyond owning shares. Inside BlackRock's headquarters, there is a technology platform called Aladdin that stands for Asset, Liability, Debt, and Derivative Investment Network. Aladdin is not just BlackRock's internal system. It has become the risk management operating system of global finance. More than 200 financial institutions worldwide, including competing banks, pension funds, insurance companies, and even central banks, pay BlackRock to use Aladdin to manage their risk. As of 2020, Aladdin monitored over $21.6 trillion in assets, nearly triple BlackRock's own assets under management. Think about what this means. Competing financial institutions, banks that are supposed to be rivals, all process their risk analysis through the same BlackRock-built system. BlackRock doesn't just own the companies. Through Aladdin, it also runs the analytical infrastructure that tells other major institutions what risks to take and which ones to avoid. One researcher described Aladdin as the hidden layer underneath Wall Street, when the same software is processing risk for both competitors and their common owners. The line between competition and coordination becomes structurally impossible to draw. Now let's talk about the part of this story that most people find hardest to believe, because it is the most thoroughly documented. In March 2020, as the COVID-19 pandemic began to freeze global financial markets, U.S. Treasury Secretary Steven Mnuchin and Federal Reserve Chairman Jerome Powell needed someone to manage an emergency rescue of the corporate bond market. They called Larry Fink, the CEO of BlackRock. The Federal Reserve handed BlackRock 3 separate contracts, without any competitive bidding process, to manage portfolios of corporate bonds and ETFs, to manage newly issued debt, and to help purchase commercial mortgage-backed securities worth up to $750 billion in total. One of those contracts gave BlackRock the authority to purchase its own iShares ETFs, the very products BlackRock sells to retail investors, using Federal Reserve money. Multiple members of Congress formally objected in writing. This was not the first time. In 2008, after the financial crisis, the Federal Reserve hired BlackRock to evaluate the toxic assets of Bear Stearns and AIG. It also advised the Fed on a $300 billion pool of assets at Citigroup. In 2023, when Silicon Valley Bank and Signature Bank collapsed, It was BlackRock that U.S. regulators hired to manage the sale of $114 billion in securities from those failed institutions. Congressional investigators documented that over the past 15 years, more than 100 individuals have passed through the revolving door between BlackRock and the federal government, central banks, and other governmental bodies. And BlackRock spends over $2 million per year on federal lobbying. This is not a revolving door in the usual sense. This is structural capture, a situation where the government's most important financial decisions cannot be executed without the cooperation of a private firm that has its own interest in the outcome. The United States is just the beginning. In the United Kingdom, the Big Three collectively hold 16.4% of the entire stock market. In Ireland, one of Europe's most important corporate tax hubs, they hold 19%. In Australia, they hold 13%. And in 16 other markets, from Japan to Brazil, they hold at least 5% of all listed equities. No government regulates them as a unified global bloc. Each country sees its own slice. None of them see the whole picture. Three companies headquartered in the northeastern United States effectively sit at the apex of capital allocation decisions in every major economy on Earth. So what does any of this mean for you? If you have a 401k, a pension, a retirement account, or a savings plan that invests in any broad market index fund, there is a very good chance your money is managed by one of these three firms. When you invest in an S&P 500 index fund, a portion of your money goes into Apple, Microsoft, and Amazon. But the voting rights that come with those shares go to BlackRock, Vanguard, or State Street. Not to you. They vote on your behalf in corporate boardrooms. And as we showed earlier, in the 2024 to 2025 proxy season, they supported management over 98% of the time. When researchers found that airline ticket prices are 3 to 11% higher because of common ownership, that cost is paid by you, the passenger. When common ownership in banking correlates with higher fees, that cost is paid by you, the account holder. When pharmaceutical companies have less competitive pressure to lower drug prices because their dominant shareholder owns all of them simultaneously, that cost is paid by you. And there is a deeper, longer-term risk for ordinary savers. Research flagged by global regulators raises the possibility that if the Big Three ever face a crisis, a massive wave of investor redemptions, a liquidity shock, a technology failure in Aladdin, the effects could cascade through the entire global financial system in ways that have never been tested before. The Financial Stability Board, the global body that monitors systemic financial risk, examined whether these firms should be classified as systemically important financial institutions. In 2015, they decided not to apply that label, partly because of fierce lobbying by the industry itself. That decision has never been formally revisited. Now, to be intellectually honest, because that is what this channel is about, the defenders of this system make serious arguments. Vanguard in particular was founded on the explicit principle of serving the ordinary investor. Index funds have genuinely democratized investing, giving ordinary people access to diversified portfolios that were once only available to the wealthy. The fees are extraordinarily low. Tens of millions of people have meaningfully better retirement savings because of index fund investing. That is real and documented. BlackRock and Vanguard publish detailed proxy voting guidelines and stewardship reports. Their decisions are, to a degree, transparent. They are not operating in a legal black hole. And many academic researchers argue that concerns about anti-competitive effects have been overstated, that the evidence is correlational, not definitively causal. But here is the tension that no one can resolve. The scale of their combined power has no historical precedent, and the oversight frameworks applied to them were designed for a different era, one where no three private firms could simultaneously be the largest shareholder in 88% of the most powerful companies in the world. The trajectory of this story does not reverse itself easily. Analysts project that if current trends continue, the Big Three's combined ownership stake in S&P 500 companies could reach 40% by 2045, double where it is today. When three firms control 40% of voting shares in every major American corporation, the concept of competitive capitalism, in the traditional sense, will have changed fundamentally. Some regulators and academics are now calling for common ownership limits, rules that would prevent a single asset manager from holding significant stakes in competing firms within the same industry. Whether those rules ever come is a political question. And as we've seen, the firms most likely to be regulated are the same firms that have spent decades building relationships inside every major government and central bank on Earth. This is the hidden power story that doesn't fit neatly into a left-right narrative. It isn't about political parties. It is about structural architecture, about who, quietly and legally, controls the most important decisions in the global economy. The question is not whether BlackRock, Vanguard, and State Street are evil. They are legal entities operating within the rules of a system. The question is whether the rules of that system were designed for a world where three firms could accumulate this much power. The answer, documented in peer-reviewed academic research, in congressional letters, in financial stability board reports, in Bloomberg journalism, and in the S&P 500 shareholder filings themselves, is clearly no. The first step in navigating any system of hidden power is simply understanding that it exists. If this video changed how you see the financial world, share it with one person who needs to see it. Subscribe to The Business Architect. And if you want to discuss this topic further or send tips for future investigations, find me on Signal at the Business Architect 123.43. The architecture of power is always built before anyone notices it.